Hello, good morning to everybody. Hi, good morning, Sadatu. You are the first one. Can everybody hear me, right? Hi, Rajiv is there. Rajiv, good morning. Thank you. Akshata is there. Akshata, good morning. Thank you very much. So, how all of you are doing? Fine, good. That's good. Nice to know. Who else is there? Yeah, I'm fine, Sadatu. How was your morning today? Good, mashallah. Very good. Nice to know that. Anyway, so tell me, what are we going to study today? You can see on the top, right? Production and cost analysis. See, we are going to learn today, we are going to do analyze actually of production cost. So let's have a look. I've got 6 people on board at the moment. Hi Prakash, how are you? Shiful Islam is also there. George is there. Hi George. So all of you are off today, or are you working? Off. That's good, George. You are lucky enough. You got 2 days off then. Rajiv is also saying off. Yeah, that's good. Must be working in the big firms who give you 2 days off, isn't it? Yeah, that's good. Yeah, you're lucky. You people are lucky enough. Now see, okay, let's move to the class. Okay, in a couple of minutes, I will be switching off my video things. Then if I remember, I'll turn it on in the last session of 10 minutes. Uh, let's go to the next slide, what it says. You know about this, right? Starbucks coffee. Who likes coffee? Who, you like tea or you like coffee? Tamila Rasi is there now. Tamila Rasi is online, yeah. Good morning, Prakash. Hey, how are you doing? I like tea more, Sadhatu, me as well. Yeah, tea. That's good, yeah. Some people, they like coffee. That's good. Say, Prakash is saying thank you very much. See, you like tea, right? Okay, that's fine. I know in India, in subcontinent, more tea there. But in Europe and America, there are more coffees there. Hi, Tamila Rasi, how are you doing? I like, George is saying I like tea. Yeah, that's good. How many cups of tea you take every day? Tamila Rasi is saying, I like tea as well, yeah, but sometime just to change the taste, I sometimes take coffee as well. Oh, George, you take 4 cups tea, right? Okay, that's good, not bad. That's good. I take 2 cups. I Shiful Islam is also there. I Shiful Islam. I've turned off my video thing, okay? I hope you don't mind. Okay, Rajiv is saying me green tea only. You will be thin, man, if you keep taking the green tea, isn't it? Someone told me like it is like if you wanna be thin, like then you take green tea. Green tea is very effective. It is spoils or burn out your fats. But I'm not 100% sure. You need to more research about it. Okay, that's fine. Shiful Islam is saying yes. So you want to be smart, right? Yeah, okay, now go to the next one. See, we are going to learn the production and the cost analysis. We'll do some cost analysis today. What are the things needs to be considered when you are going to do the production analysis or the cost analysis of a product, of goods, of your goods. Let's see, give it a go, what it says. These are the chapters goal actually. I mean, we'll try to cover these stuff in today's lectures. Differentiate economic profit from accounting profit. We'll try to know what are the different, very delicate differences there. So we'll try to know what are the differences between economic profit and accounting profit. Hi, De Silva. Hi. After a long time, I think I saw you. Good morning. How are you? Elaine De Silva is there. I'm not bad. So it's my practice, so don't mind if I say I'm not bad. In England, people say not too bad, and in America, people say not bad. So it means I'm okay. Anyway, yeah. Let's go see, or we'll try to learn what are the differences between economic profit and accounting profit. 148, 148, 14. I don't understand, Prakash. 14 and 148. Anyway, it might be some chat code or something like. And distinguish between the long run and the short term productions we'll have. So if you're going to produce something on the long term basis, then that might be a different scenario than when you're going to produce something for the short run. So there are some more things you need to consider, and you need to be more careful when the things are produced and for the short run. So introduce new law of diminishing marginal productivity. So we'll have a look at the diminishing marginal productivity and how it is related to the cost production. See, and calculate fixed cost. There are some fixed cost when you're planning to produce something. So you have to install machines, you have to install plants. Suppose, Prakash, you cannot hear me. I'm sorry. Can everybody hear me, right? Okay, then the problem is not from my side. George, Nimrala, Tamilarasi, Maria, Elaine De Silva, Sadatu Osman, everyone is saying they can hear me. So you please look at your mic, yeah, please. Or your speaker. You must be looking at your speaker, not your mic, because so you got something like hearing device. I mean, yeah, speaking device, some problem. No, so when you are when you produce something, you need, of course, plant, machines, you need plots, you need buildings. Those are your fixed assets, So these are the fixed costs. These are the fixed costs, which are normally do not change over years, maybe for 5 years, for 10 years, okay. But there are some variable costs. We learned what are those variable costs in detail, okay. The marginal cost, total cost, average variable cost, and average total cost. So these are the things we are going to have a look at. So, okay, let's go to the next one. Distinguish the various kinds of cost curves and describe the relationship between them. So we are going to also study the relationship between the different costs, like fixed cost, variable cost, and average fixed cost, average variable cost. So what are the relationship between them, and what are the things you must know before you think about your production, you forecast about your production, and you give the order as a manager, production manager, you give the order to produce. So you must know these things, okay, which comes within managerial economics. Let's go to the next one, see if I got more points. Yeah, so these are the yeah, okay. Now the role of the firm. What does a firm or an organization do? Simply what they do in the supply process. People offer their factors of productions such as land, labor, and capital to the market. Simply you can say the firms, what do the firms do, or the organization they do? they use factors of production like land, labor, and capital to produce some stuff, some goods, or to produce some services to present in the market. Right? Clear? I mean, you mix up your factors of production, which are land, labor, capital. Okay, so in a way that there is something meaningful should be produced. It may be in the form of production, goods, or it may be in the form of services which is presentable in the market. Is it clear, everybody? Okay, that's good. Yeah, Tamila and oh, it's not Tamila, is saying Nirmala. Nirmala is saying yes. Rajiv is saying yes. Okay, that's nice to know. It's getting, everybody is getting clear. Okay, let's go to the next one. What does it say? The same thing I've already explained. Firms transform the factors into goods or for consumers, or services for consumers. Production is the transformation of factors into goods. So yeah, this is the simple, very simple definition of production. Production is basically the transformation, or is the change, or is the result of factors into goods. When you use the different factors of production, or the factors like land, labor, and capital, to produce something that is called to transform into some good, that is called that action is called that process is called the production. Okay, let's see what it does says. Yeah, ultimately all supply comes from individual because control of the factors of production. Now, a firm is an economic institution that transforms factors of production into goods and services. We have already learned it. See, the firms organize factors of production. I have already told you they organized, or they utilize the factors of the scarce factors of production in a way that can produce some goods and some services. Produce goods and services, and or sell produce goods and services for the purpose of to sell that in the market. Okay, clear, right? Let's go to the next one. The role of the firm. Yeah, we are virtual firm organize production and contracts out all work. This is not very important. Many of the organization structures of businesses are being separated from production process. I'm slightly trying to be quicker because we have to go to the different type of curves and do some analysis, and that might take a lot of time. That's why I'm slightly quicker. But still, if you have any problem or anything which is confusing or any misconception, please chat on the box. The firms, this is one of the major motto of firms, that what they do, the goal of a firm is to maximize profit. Of course, that is one of the main. So, and you know the profit, how the profit is calculated, you know, all of you, we studied before, like total revenue minus total cost. And total revenue is calculated, how total revenue is calculated when you multiply cost of individual product by the total number of product, then you get the total revenue, right? Suppose you're in the business of producing television, and one television is you're selling for £1,000, and suppose it's a very nice television you're producing, like 56-inch television, right? So, and you multiply, and how much you are producing every year, suppose 500, so you multiply 500 by 1,000, so that will generate your total revenue. Is it clear, right? And to produce that much television, of course, you have to go through a lot of cost, you have to bear with a lot of cost, and that might be some variable cost, some fixed cost. So total cost, salary cost, when you minus those costs, then out of the total revenue, then you get total profit. Is it clear, right? Akshata is saying clear. Yeah. Nirmana is saying also clear. That's good. Nirmala, yeah. In Shiful Islam, Tamila Rasi is saying yes. Today I will take Tamila Rasi on the mic, and she will be saying a lot of things today. I think so. Okay, Tamila Rasi, right? And then Insani is also saying yes. Tamila Rasi is saying no. Why? You are not. You don't need to be confident. Okay, MBA students have to be very confident and public facing. So you are going to do it today. Now let's go. Let's see. Okay, let's go to the next slide. For economists, total cost is the implicit payments to the factors of productions plus the opportunity cost of the factors provided by the owners of the firm. So this is simply what is the definition of the total cost. Total cost is the explicit payment to the factors of production. I mean, whatever, how much you spend to produce that is stuff in the form of you give the salary to the labor, you buy different parts, you pay the utility bills, you buy the lands and the buildings and all the other expenses that is which is countable in the accounting books. I mean, they are recorded in your income statement, in your balance sheet, they are recorded. So that is called total cost. Okay, that is called total cost. But the explicit payments, okay. And let's see, there are some very minor difference between the, in point of view with the economist and accountant. What does it say? See, for economist, total revenue is the amount of a firm receiving for spending its product or services plus any increase in the value of the assets owned by the firm. See, like suppose what exactly happened, the economist, they look at the total revenue or the total cost in a broader point of view. For example, suppose you have a building, where you are producing some stuff, okay, producing some goods, and so the accountant is going to write the price, he will write down the fixed cost of the building, okay, in the column of assets, right, in the column of fixed assets. But if you have a like increase of the building price, like suppose the building price has gone up, so the economist will include those prices as well. Normally, which prices are not included in the book of accounts. See, another example we have got, see, that those are called like implicit cost or implicit revenue. See, here see, accountants focus on explicit cost and revenue. Okay, like accounting profit will be explicit revenue minus explicit cost. Simply, the profit is revenue, total revenue minus total cost. So, okay, this is very simple. But economists focus on both explicit and implicit cost. What are the implicit costs? That's the question. See, economic profit it says implicit revenue, explicit and implicit revenue minus explicit and implicit cost. So if you understand the word implicit, then it will be very clear to you. Like suppose they are not recorded like the opportunity cost. If you remember, we studied about the opportunity cost. They are the one which accountants are conservative. Rajiv is saying accountants are conservative. Anyway, I don't know in what, please explain again, sir. Okay, we are going to explain it like, but just you need to understand what is the meaning of implicit cost. Suppose one of the employees there, right, and is working for your organization. So if he goes on holiday, I think economists are more conservative. Anyway, there is a contradiction now. I don't know, contradiction of opinion, so you people might go into the detailed discussion about it. That's not a problem, or sometime I will allow you to speak to your point of view later on. Let me cover the topic here to some extent, please. Yeah, because they count every penny. Yeah, that's good. Sadatu is saying economists are more conservative because they count every penny. Okay, and anyway, for every angle, yeah, like yeah, that's true. I mean virtual cost, they also include the virtual cost as well. Okay, now see. Okay, so implicit cost is, suppose there you have an organization where there are a couple of employees working for you. One of the employees could go on the vacation for vacation, so he would be. It would cost him. It would cost him like his ticket, when the hotel cost, ticket cost, traveling cost. Okay, these are the. But on the contrary, he is going to lose, or like he might be. What you are going to lose is his salary. I mean that employee. If it is not paid salary, if it is not paid leave, then he might be losing his salary. So that is actually that is his implicit cost. That is called the implicit cost. Normally they are not recorded, like the opportunity costs, which are not recorded in the accounting books, but economists they consider those costs as well. So I give you another example, say not paying rent on the self-owned property called implicit rent. Like suppose implicit rent is an implicit cost, because rent is a tax deductible expense, but implicit rent is not similarly. So implicit cost is a liquid asset of or stockholders. So always remember, suppose you live on your own, suppose you're using a building where your production is going on, and if you had rented that property, you would have got some rent. So that is your implicit cost. Is it clear, right? Which is not recorded in the book of accounting. Okay, that's fine. Okay, clear. So let's go. Now see what it says, the production process, short run and long run. Yeah, so you can produce some stuff on the basis of short run, and for long run. See what it says. See, a firm is considered in the regard to what production decision it can make, and some inputs are fixed. Like what are those inputs which can be fixed for the short run and even long runs? What are those inputs will be fixed, do you think? Let me come up with your answers, please. Quantity of often to be produced. That's not the very right answer. Some inputs are those factors of productions of those which you use or which you give as the input to get some outputs. Yeah, land. Sadatu is right. Yeah, land, machines. So for short run, even some inputs are fixed, right? Okay, that's good. Yeah, because they are fixed cost. Okay. See, a firm is constrained in regard of what production decision it can make, and some inputs are fixed. A firm and on the long run, a firm chooses from all possible production techniques. All inputs are variable. In that case, all inputs are, what will happen? All inputs are variable, like your suppose your salary, your cost of your parts. Suppose you are in manufacturing industry of car, so you need a lot of parts to manufacture the car. So those all inputs may be the variable, and some inputs are fixed. To see the terms long run and short term do not necessarily refer to a specific periods of time, but to the flexibility the firm has changing the level of output. Yeah, suppose if the firms want to produce within a month time, or within 6 months, that is a short run. And if it wants to produce to supply for the 5 years to come, for the 10 years to come, over a year to come, so that is the long run production. Now we are going to have a look at the table, long run production table. See, Now see, this chart is very important. If you have a look, see how now you will understand the difference between the marginal product. This is very important. If you understand this chapter, this table, then the later all the curves, to understand all the curves and exactly what are the relationship going on between the different costs, it will be easier for you to understand. See, what it's saying is number of workers. Suppose 0 workers, there is no production, right? So total output is 0. So there is no marginal product, there is no average product, because there is no one to work in the company. Is that your company, is it? Let's see. Okay, now what it says, if you have got one worker to work for your company, so he produce or she produce 4 units, right? And see the 4 units. So the marginal product will be 4. Marginal product is basically the difference of the addition of individual worker. Like suppose 4 workers making 5 units, 5 pieces, and 5 workers making 8 pieces. It means in addition of 1 worker, 3 pieces are more produced. That is called marginal product. Clear? Okay, that's fine, yeah, as long as it is getting clear. So now let's have a look, see exactly what's going on. See, for suppose when there is a 1 worker, they are producing 4 units, right? And the marginal productivity is what? Is 0 minus 4 is 0, right? Sorry, is 4. Now there are, see, so the average is 4. Why average is 4? Because 4 divided by 1. Average, when you talk about the average product, it means the total output will be divided by the number of workers. Yeah, Elaine is saying, Elaine De Silva is saying 4. That's right. So now see, if you look at it, see that when there are 2 workers, they are producing 10 units. And see, the 1 worker was producing 4 units, and in addition of a worker, you are accepting 6 units, you are getting 6 units more. So your marginal product is 6. And the average product will be 10 divided by 2. It means how much each worker is producing on an average. Yeah, so that is clear, right? 5. Yeah, that's good. Okay. So, okay, that's fine. Now, what exactly going on? See, when you are keep increasing the number of workers, right? So the production is also increasing, total output. Okay. See, your production was maximum, right? When you were using 7 workers, right? But it is slightly getting slower as well. If you have a look, the marginal product, yeah, is going to be slower now. First, it increases from 4 to 6, then 6 to 7. Then it starts decreasing, 6, then 5, then 3, then 1, then 0, and it went to negative now. And similarly, if you do look at the average product, right? These are the cost basically, remember, these are the cost, right? See what exactly going on. See, first the average product was 4, it means very, okay. Then it increased, it means each employee is participating more to produce. And then 5.7, 5.8, now it started going down, diminishing now. 5.6, 5.2, 4.6, 4, 3.3, and 2.5. How that marginal product calculated? Okay, Renin is asking. Okay, Renin, have a look. See, if you have a look, 2 workers producing on the workers column, have a look, 2 workers producing 10 pieces. Total output is 10, right? Yeah, okay, and see, and 3 workers are producing 17. So when you add 1 worker more, then you are getting how much more units? 17 minus 10. It means 7. This 7 on the column of marginal product is the difference between 17 and 10. as a result of addition of one more worker, because they don't see the reason for paying more when production is not increasing. Someone has raised his hand. Okay, I will allow you. Okay, no problem. Here you go. Sadatu wants to say something. Okay, that's fine. Sadatu, here you go. I'll allow you now. You post, I post question. Just want you to read it. Okay, okay, no problem. That's fine. There is a question. She has posted. Let me see. Where is the question? Yeah, is it such case at 8, such case as 8 that economics downsize? Is it in such cases as 8 that economics downsize? No. Downsizing is something different. Downsizing is something when you start the economics downsize. Economics downsizing is not a very appropriate terminology. So that you please make your question more clear. Then I will be able to reply. Okay, read the further. Okay, read the other comment. Okay, an additional output coming out from the additional worker is called marginal product. Yeah, that is the correct answer. Sirenin, she is giving the answer. That's why I told you when you add one worker, and in that case you get more product. Suppose from 3 workers you are getting 10 pieces. Now when you add one more worker, 11 workers making 14 pieces. So in adding one more worker, you are getting 4 pieces more. So that is your marginal product. Okay. You're facing technical difficulties, so sort it out, please. I don't know what type of technical difficulties you have. If it is something device problem, so please sort it out. Okay, that's fine. Okay, let's go to the next one. Now, see, well, yeah, what I want you to concentrate here, see, what exactly going on. When you have like 7 workers working for you, you got 32 output, right? And when 8 workers start working for you, you're still getting 32 pieces. So there is no use to add one more worker. What exactly now when you're putting one more worker, like 9 worker, and that now your production is going down. From 32 is gone down 30. It means now marginal product is -2. So my question is that how is it possible like you're adding up more workers and the output is going to be down? My question is that. Can anyone reply me, please? Because this is very important. This concept is very important here. Less tools. Renin is saying less tools. Okay. A machinery, etc. That's, I mean, less machinery. Salary, yeah, salary could be one of the reasons. Scarce resources, maybe. That's good. Okay. That's okay. Okay. See. Okay. Tell me. That's okay. Scarce resources, maybe. Not the scarce resources, that's not. What exactly happened when you have more people to work for you, then you have to pay them salary more. And that will increase your cost of product. And when the cost of production increase, of course, that will affect your profit, your revenue. That's the reason, like when you have more people, of course, you have to pay them more. You have to pay them salary, their medical and other benefits as well. So that's why you have to find out a way of like an optimal point where you can use your resources, your limited resources, human resources or other resources to generate the maximum output. You have to find out that point. Clear? See that point when you're producing your marginal product was 6 when your marginal product was 6 and your average was okay. Yeah, Rinin is saying it's clear now. You didn't read the other comment. Okay, which other comment? Scarce resource maybe. Yes, size, that that is what I was thinking about in the question I posted. Yes, Datu, you are right. Yeah, I agree with you. That's true. Sorry, I just missed it out your second comments because I'm trying to be slightly quicker. That's I want to finish it today. See, look at it, the marginal product. With the marginal product is your maximum when you are using like see, when you are using 4 workers and they are generating 23 outputs, 23 units, and that's why 23. Yeah. When you are using, that's true. When you are using 3 workers and they are generating 17 17 units, then 17 minus 10 is 7. So that is your marginal product is maximum is 7 when you are using what 3 workers. Elaine, thank you very much. So that's why you have to be careful, and that's why in that place. See, okay, let's go to the next slide. Now it will be clear for you to understand the curves or the like that graphs. And you are okay with the average product, right? Yeah, that's what I have already explained to you. What is average product is and what is marginal product is. Now look at it. See, number of workers on the horizontal axis. Okay, number of workers on horizontal axis. So, and the quantity is the quantities are on the vertical axis. How many units is produced? Those are your quantity, right? See, if you have a look, that graph is not. I mean, it's not a very perfect one, but it is okay. See, the first you look at the this curve is going on. That is the production. A production function is the relationship between the inputs and the outputs. So this is your total production curve. See, in the first time, see the increasing marginal productivity. And what happened when you are using like around 6 to 7 workers, then your increasing marginal productivity start going down. And it will come up when you keep increasing your productivity, your number of workers, it will go to the negative section. It will go down below that line. So that will be that when we look at the 14 workers, I mean in the previous one. See, let's have a look to the previous chart. See, when there were 9 workers, so the marginal product went down. It's minus 2. But I don't think so that graph is produced according to this data. But it is just an overview to understand the relationship between the marginal product or how it works. So this is the line of the total production. See, like 1 worker, and when you are using 2 workers, your quantity you are generating is more. Still in 3 workers, it is generating more. In 4, it is generating more. But when you are using 6 workers, it is coming as a horizontal line now. And after 7 workers, it starts coming down because you have to pay more salaries, and that will increase your cost of productions. That will increase your cost of productions. So that's why it will start coming down. And under one of the case, it will go down this line. So it will start the negative things. So this is between this line is between 2.5, between 3 and 7 is the diminishing marginal productivity. It means the marginal productivity is going down. And the second one is from 8, 9, 10 is a diminishing absolute productivity. It means it is going towards the negative now. Okay, right? Is it clear, right? This is the curve exactly showing you the total productivity between the excuse me, between the number of the workers and the total quantity produced. Okay, everyone is saying yes, clear. Okay, thank you very much. Let me go to the next one. See, this is what they're saying, graph marginal and average productivity. See, this is this green one is your average productivity, okay, in respect of the number of the workers. So Dhatu is saying, does this explain the law of diminishing return? Yeah, you can see, of course, that is the law of diminishing returns. No, just retaliating. Sorry, sir. Why are you saying sorry? You are okay. You can come up with your own ideas. That's nice. It means it shows your involvement. It shows your your inclination to to learning. That's really good. Yeah, I am in the office, but I don't want to miss this interesting lecture. Okay, that's fine, Rashid. That's good. You don't have Saturday off, right? Relating. Okay. No, it's okay, Datu. You're more than welcome. You're participating with us. That is good for us even. So that's okay. Now let's see. Have a look. See, this is average product. This is number of workers on the horizontal line, and on the vertical line the quantity produced. So if you have after 7 or 8 workers, your marginal product is going to be negative. So if you see the marginal product is go quicker, very high, then the worker were 3 and 4, and then it start coming down more adversely. So when you have more laborers to work for you, so your marginal product will go down. Even your average product will go down, because the number of the total workers will divide the total productivity, the number of units produced. So number of units produced will be divided by the number of workers. So the more the number of workers, the less will be the result. So that's why your average product is also going down, but it is slightly horizontal. But your marginal product is more U-shaped, is more vertical. Okay, it's going to the vertically downward. Is it clear? Okay. Okay, that's fine. Everyone is saying it's clear. That's good. See, that's what I've already explained to you. This is the same chart we studied before. Let's see. Law of diminishing marginal productivity states as more as variable input is added to an existing fixed input, after some point the additional output from the additional input will fall. That's we have already seen in the graph. Through the graph, we have already seen this law of diminishing marginal productivity, how it start going down, your marginal productivity. See, these are the portions where C4, 6, 7 is increasing marginal productivity. It is increasing continuously. Then it start going down. See, diminishing marginal productivity is from 6 to 0. And then there will be absolute, it is going to absolute productivity diminishing. It means it's going to the negative value now. So you have to sell out your firm now. Okay, if you do so, then you will have to, it will be a bankrupt. You understand what I mean? I don't think so you can afford it, can you? As an entrepreneur of your own company. Yeah, now let's go to the next slide. I think this is very clear to all of you. See, the fixed cost, those that are spent and cannot be changed in the period of time under consideration. You know about it, about the fixed cost. Someone has said something. Yeah, Renin is laughing. That's good. That's good. Nice sign. Yeah, George is showing he cannot afford it. I know, George, you cannot afford it. So that's good. Yeah. See what exactly going on. The fixed costs are, the fixed costs are normally for the more than a year, like your plant, your machines, right? Okay. These are the costs which are not changed frequently, or they like for within a year. They work for 5 years, 10 years. Those are your fixed costs. I mean, when you are going to buy a machine or a robot or a computer, they work for over a year, 5 years, for 10 years. That cost are fixed cost. Those costs are fixed costs. Now see, in the long run, those are the no fixed costs, since all inputs and therefore their costs are variable. In the short run, a number of inputs and their cost will be fixed. Yeah, in short run, a number of inputs and their cost will be fixed. Like suppose this, when you buy spare parts and stuff. So you have to buy every time throughout the year. Whenever you want to produce, you have to buy them. So those are your short run input cost. Let's go to the next slide. Let's go to the next slide, the cost of the productions. Hang on a second, guys, here, please. Hello, can everybody hear me now? Sorry for the interruption. Hello? Okay, yeah, sorry for the interruption. We got some guests and like visitors to see how the live classes are going on. I mean, they came from abroad. So I just showed them, like, see, my students they are very regular, and they're taking the classes. So just wanted to build up your image, you understand, to our visitors. So that's good. Okay, and sorry for the inconvenience that may cause to you. Okay, let's go to the, let's carry on Okay, thank you very much, Elaine. You have come down from which country? Okay, I am from Pakistan basically, but I used to live in England, and I did my education in England. Okay, Renin, thank you for your appreciation. Let's go back to our discussions. How everyone likes that, but believe me, my accent is not a British accent. It's like Pakistani Indian accent, but might have some sort of tone because I lived there many years. Anyway, thanks for your appreciation. Go to the next one now. See what it says. The cost of production, I told you what are the fixed cost and variable cost. Variable cost that may vary, like for which are costs, suppose like you may have different salaries for different type of staff, for different type of labor work. So these are your variable cost. May have some lower parts, cheap price parts, and may have some parts from Japan and some parts from China. So you understand what I mean, right? So these are your these are your variable cost, which may vary within a year. See what else we got in the next one. Yeah, see what it's saying is, as you know, the cost of production, total cost, what it says is workers are an example of variable cost. I already told you, workers are an example of variable cost, which are costs that change as output changes. The sum of the variable and the fixed cost is the total cost. Yeah, so what are your total cost? When you add the total fixed cost and your variable cost. Fixed costs are over a year or more than that, more than a year, and your variable cost, when you add them up, so that gives you the total cost. Okay, it will be very useful for us when we do some analysis of our graphs. So you must know that total cost is the sum of the fixed cost plus variable cost. Let's go to the next one. Yeah, see the total cost, the cost of production, average fixed cost equals fixed cost divided by quantity produced. See, now see what average fixed cost. You are going to find out AFC, which is equal to fixed cost divided by quantity. So average fixed cost equals fixed cost divided by quantity produced. Is it clear, right? How much quantity is produced, that if it is divided the fixed cost, then you will find average fixed cost. Okay, then go to the next one. Similarly, to find out average variable cost, you will find out the total variable cost and divided by the number of the quantity produced. That will give you average variable cost. So once you add average variable cost and average fixed cost, so it will give you average total cost. It means ATC. Any doubt? Please let me know. Okay, let's go. I don't think so I will be able to finish it today. Anyway, see, I have already told you the average total cost will be the sum of the average fixed cost plus average variable cost, right? Now, go to the next one. Yeah, marginal cost. Similarly, marginal cost is the increase in the total cost when our output increased by 1 unit. I've already told you, when you increase one worker, and as a result of that increase your number of output, or decrease in your number of output, that is your marginal cost, right? And that marginal cost is equals to total, like it's a change of total cost divided by change in quantity. So that you can see the delta sign is there. So that is the total cost. So that is the total cost, marginal total cost, change in total cost divided by quantity produced. That will give you marginal cost. Clear? Any doubt about it? Okay, that's fine. See, the same table now, have a look at it, what exactly going on, because we will having now more graphs, but unfortunately, Maria is saying no. Okay, Maria, tell me where is the problem, please. I'm just waiting for Maria's response because can you repeat it? Yeah, no problem. I can go back. So what exactly where exactly you have the problem, like marginal cost or average total cost or average variable cost or average fixed cost you have? Average total cost, Maria is saying. Okay. See, like total cost, how do you find out the total cost? You find out the total cost when you add the fixed cost and variable cost. And how do you find out the average variable cost? When you take the total variable cost and divide by the number of the worker, so that will give you the average total cost. Average variable cost. Similarly, you will find out the average fixed cost. When you add average fixed cost plus average variable cost, that will give you average total cost. See, average total cost is the sum of average fixed cost plus average variable cost. Okay, that's fine, as long as it is clear now, Maria. Thank you very much. Go ahead. I'm regret to tell you that I don't think so we will be able to finish it today. If it is not, I will come up with the same topic, and finish it in the next time, inshallah. See what exactly going on. This is very interesting. See this graph is, see on the horizontal line you have quantity, right? Number of work, how much is produced. That is your quantity, like 4 units, 8 units, 12 units, 16 units, 24 units, 24 units, 28 units, 32 units. They are produced, right? So that is your unit, unit you are producing. That is your quantity on the horizontal line. And if you go on the vertical line, which is, it's not available, but I'll make it available, inshallah. Okay, then nothing to worry. Once it is finished, I'll upload it and you can have it, or I'll tell the student affairs to send it to you straight to your email address. Okay. Okay, that's fine, no problem. See what exactly going on is total cost. Like as you can see, suppose the total cost line, which is the black one. See, when you are using 4 units to produce 4 units, total cost is more than slightly 100. To produce, when you want to produce 8 units, the cost is more. It is smoothly going up at the beginning. Then it start going up. It means now it is total cost is your increasing harshly. I mean more total cost is increasing because the line is getting more vertical now. Okay, because you have to pay the salary to the workers. So that's why to produce now, to make more quantity, so you have to buy more parts and stuff. So what exactly going on? The total cost is continuously increasing, right? And see the VC, I mean your variable cost is also increasing. when you want to produce more stuff, so of course that is directly proportional. So total cost will be more if there are more productions, even the total cost, even the variable cost. Let's go to the next one. Hello. Sorry, I think I ran out